price-earnings ratios are very high relative to what we had in the last 30, 40, 50 years. But then, when you just focus on the price-earnings ratio, you're not looking at the alternative. With bond yield being so low, there's basically no ability to earn any income investing in bonds. And cash gives you nothing too. You're left with the stock market. In general, there is much more uncertainty about valuation these days. Because when interest rates were very high, if you can predict the next 10 years, you can already explain much of the value. Now you need to predict the next 30 years before you can explain much of the value. It means that only a very small part of the value of a stock today is related to the earnings that they are going to generate in the next 10, 15 years. Most of the value is about the earnings that are going to be generated 20, 30, 40 years down the road. And in this sense, earnings quality, not just earnings quality in terms of what will happen to earnings next year, but rather in terms of the ability of a company to maintain sustainable earnings, is the key point. More than growth, definitely not what will happen next year or next 2 years, because this is not what is going to matter for value. What is going to matter for value is the long run, the very long run. For those earnings we're willing to pay.